RSI is one of the most misunderstood tools in trading, and I think the main reason is simple. People treat it like a signal machine when it is really just a momentum gauge. RSI stands for Relative Strength Index. In plain English, it measures how fast price has been moving up or down over a chosen period, usually 14 bars. It doesn't tell you whether a market is cheap or expensive in any absolute sense. It tells you whether recent gains or losses have been strong enough to push momentum toward one side. The basic reading is easy. RSI runs from 0 to 100. A reading above 70 is often called overbought, and below 30 is often called oversold. That language is useful only if you understand the limitation. Overbought does not mean sell now, and oversold does not mean buy now. It means price has moved strongly in one direction recently. In a strong trend, RSI can stay elevated or depressed for a long time, while price keeps moving. That is why beginners get trapped when they use the number as a reversal trigger by itself. The formula behind RSI is not magic. It compares average upward movement to average downward movement over the look-back period, then converts that balance into a scale from 0 to 100. If recent gains dominate, RSI rises. If recent losses dominate, RSI falls. So the indicator is really answering one question. Are buyers or sellers controlling the recent pace of movement? That is useful, but it is only one piece of the picture. It does not include volume, trend structure, or where price sits relative to support and resistance. Here is how traders actually use it when they are being careful. First, they use RSI to confirm trend strength. If price is making higher highs and RSI is also holding above the middle zone, that supports the idea that momentum is still healthy. Second, they use RSI to look for divergence, which means price makes a new high or low while RSI fails to do the same. That can hint that momentum is weakening. I treat divergence as a warning, not a trade on its own, because it often appears too early and can last longer than expected. The most common mistake is using RSI in isolation. A market can look overbought and keep rising. A market can look oversold and keep falling. Another mistake is forcing the same thresholds onto every market and time frame. A 70 reading on a fast intraday chart is not the same as a 70 reading on a daily chart. Context matters. Trend markets and range-bound markets behave differently, and RSI works differently in each one. In my view, RSI tends to work best as a filter, not a standalone entry system. It is most useful when you already have a reason to care about trend, momentum, or exhaustion, and you want a simple way to measure whether that pressure is strengthening or fading. It tends to fail when traders expect it to predict turning points with precision. If you want one clean lesson, it is this. RSI is a momentum thermometer, not a fortune teller. Use it to read the temperature of price, then let structure and risk management do the real work.